Welcome back to the Deep Dive. If you've been following the AI race, you know the real bottleneck isn't just ideas.
Right.
It's the physical stuff, the specialized computing power you need to actually train and run these massive models.
The picks and shovels.
Exactly. And today we're diving into the financials of a company that is, well, trying to corner that essential market. And the scale is just staggering. I mean, one number really tells the whole story. $55.6 billion.
And that $55.6 billion, it's not their market cap. It's not some wild projection.
Wow.
That is their actual contracted future revenue backlog. As of the end of Q3 2025, it's a monumental figure. It really defines the new economics of AI.
It has to. So our mission today is to unpack this. We're looking at the Q3 2025 earnings presentation from CoreWeave, one of the big pure-play AI cloud providers. We want to understand how they're capitalizing on this, insane demand, why they seem to be winning these huge deals, and maybe the most important part,
How they're paying for it all.
how they are financing infrastructure that costs billions to build before they see a single dollar of that revenue.
Well, they brand themselves as the essential cloud for AI, and you can see why. This isn't like the general purpose cloud from the big giants, the AWSs or Azures of the world.
It's different.
It's architecturally different. It's optimized for GPU density, specifically for AI training and inference. And that specialization is why they're pulling in the biggest names.
And the Q3 results really seem to prove that model works. So let's just hit those top-line numbers first.
Let's do it.
They reported revenue of $1.365 billion for the quarter.
Wow.
Which is a 134% year-over-year revenue growth.
Triple-digit growth. That's just incredible at that scale.
And then you look at their efficiency metric. The Adjusted EBITDA came in at $838 million.
Which is a 61% margin. That is a massive margin.
61%.
That combination, the huge growth and the high margin, it shows you this isn't just a volume game. It's a very high-value service they're selling.
To put that growth in perspective for you, I mean, a year ago, Q3 2024, they were at $584 million.
Right.
And now, 12 months later, almost $1.4 billion. The demand signal is just relentless.
Relentless is exactly the right word. And that brings us right back to that monumental revenue backlog you mentioned.
The ocean.
The ocean, exactly. If revenue is the stream, this is the ocean.
So what exactly is this $55.6 billion made of? What does its growth tell us?
Okay, so the backlog is basically future revenue that's already locked in by customer contracts. The size is one thing, but the velocity, that's astounding.
How fast did it grow?
It grew 271% year over year. But get this, the company said it almost doubled in just one quarter.
Doubled in a quarter.
Yes. This isn't steady growth. This is the entire market rushing to lock in its capacity for the future.
And this is the real insight, right? This isn't built on, hundreds of small contracts.
Not at all.
This backlog is driven by huge, multi-year deals with the most compute-hungry companies on the planet. So who are they? Who's writing these checks?
Well, you're looking at the big three, really. OpenAI, Meta, and then multiple large hyperscalers who are basically using CoreWeave's specialized capacity themselves.
And the deal sizes are just mind-boggling.
They are. I mean, look, they signed a multi-year deal with Meta worth up to approximately $14.2 billion.
$13 billion.
And then with OpenAI, they expanded their partnership. They added a new $6.5 billion deal, which pushes their total commitment with just OpenAI up to about $22.4 billion.
Hold on, $22.4 billion just for OpenAI's capacity.
Just for OpenAI.
Yeah.
It's a foundational bet on a single vendor.
But that has to raise a question, right, about client concentration risk. I mean, if that much of your future is tied up in just 2 or 3 names, how risky is that?
It's the necessary risk of this hyper-specialized model. But the contracts themselves, they give you some insight into the stability. If we look at the timing for that $55 billion...
Revenue recognition.
Exactly. The vast majority isn't coming in tomorrow. Only about 8% is expected to be realized in the next 2 years.
Okay, so a small slice up front.
A very small slice. Then 42% is projected in that 25 to 48-month window. So years 2 to 4.
And then the kicker.
The absolute kicker, 50%. Half of the entire $55.6 billion backlog is projected for 49 months and beyond.
So 4+ years out.
4 years into the future. Clients are securing their AI compute capacity for the second half of the decade. That kind of deep, long-term commitment, It just insulates them from short-term market swings.
And it locks out competitors.
It absolutely locks key competitors out of securing that prime capacity.
So the customers are committed, but like we said, commitments don't pay the bills today. The real story here is the cost. Let's shift to the CapEx furnace driving this whole thing.
Right. You can't support $55 billion in future contracts without spending billions first.
What was the number?
The capital expenditure is the anchor here. In Q3 2025 alone, just one quarter, CoreWeave spent $1.9 billion in CapEx.
$1.9 billion.
And that's money just poured directly into scaling the infrastructure, property, equipment, all of it.
Yeah.
They're in a race to build the track before the race even starts.
And this massive investment, it leads us right into the complexity of their profit figures. Because on one hand, we see these amazing operational metrics, the 61% adjusted EBITDA margin.
So looks great.
But then you see a net loss. So for a listener who isn't, deep in corporate finance, how does that work? Why does a company that looks so profitable operationally still lose money?
This is the absolute crucial distinction you have to make when you're looking at a hyper-growth infrastructure company. You have to separate GAAP from non-GAAP. The adjusted EBITDA of $838 million and the adjusted operating income of $217 million, they show that the underlying business, the actual selling of compute,
Is hugely efficient.
hugely efficient. A 16% margin on that adjusted operating income.
But the net loss.
Right. The adjusted net loss was $41 million. That's compared to basically being break-even a year before.
And why is that?
It's driven by non-cash expenses, specifically depreciation and amortization, and then massive interest expense from all the money they borrowed to finance that build-out.
So it's like, your salary is great, but the mortgage payments on the huge new factory you just bought are dragging you into the red.
That's a perfect analogy. The infrastructure is depreciating on paper, the debt is hitting the interest line, all while the revenue from it is spread out over that 4+ year window.
Okay, so for full transparency, what did the strict GAAP numbers show?
As you'd expect, the GAAP net loss was bigger. It was about $110 million, but their GAAP operating income was actually slightly positive. $51 million, a 4% margin.
So what's the takeaway here?
The takeaway is clear. They are prioritizing market share and capacity over everything else. They are leveraging massive debt and taking a short-term accounting hit to secure what they hope is a dominant long-term position.
Which brings us to the actual physical scale of this dominance. Where do they stand today as of Q3 on their physical footprint?
They are planting flags everywhere. They're operating 41 data centers right now.
41?
And in terms of power, they've got about 590 megawatts active online today. But the really ambitious number is their contracted power,
Which is?
about 2.9 gigawatts.
Wow.
They are locking up the land and the energy for the next decade of AI growth.
And that capacity is being filled with the absolute best hardware you can buy.
The best you can get. Their relationship with NVIDIA is everything. CoreWeave made a huge deal about being the first to deploy the cutting-edge NVIDIA GB300 NVL72 systems.
The new Blackwell architecture.
The absolute top of the line, foundational for large-scale training. They were also first to make the RTX PRO 6000 Blackwell server instances generally available.
So they get the newest toys first.
They do, and that's reinforced by a $6.3 billion strategic collaboration agreement with NVIDIA.
$6 billion just with NVIDIA.
Just to accelerate their access to and scaling of the latest and greatest GPU infrastructure.
Which brings us to the really complex funding strategy. You don't get to 2.9 gigawatts without raising just monumental amounts of capital. How are they structuring the debt?
Yeah, their strategy is heavily weighted towards some pretty sophisticated debt instruments. They raised $1.75 billion through senior unsecured notes.
At what rate?
9% due in 2031. But they also secured a $2.6 billion delayed draw term loan facility. That's DDTL 3.0.
Can you break that down? DDTL, SOFR. What does that signal?
It signals a very sophisticated low-cost financing approach. A delayed draw term loan means they don't borrow all $2.6 billion at once.
Right.
They only draw the money as they need it for construction, which keeps their interest costs down. And SOFR is just the new benchmark rate for these massive, secure financing deals.
So they're being efficient, but still. 1.75 billion at 9% is not cheap money.
It is not. It tells you everything about the return on investment they must be projecting for those new data centers.
And they are seeing their terms improve.
They are. They amended an older facility, the DDTL 2.0, and increased it to $3 billion. And the new pricing is significantly below what they were paying before, which suggests the market's confidence in them is actually increasing.
And they didn't just use debt. They also made some moves on the equity side.
Yes, they did. They satisfied some obligations related to their Series C preferred stock, which had the effect of increasing stockholders' equity by $1.2 billion.
Which is crucial.
It's crucial. The debt investors need to see that solid equity foundation underneath all that leverage.
So let's close the loop here. Can you give us some tangible examples of where this mountain of capital is actually going? Where are these flags being planted?
Okay, so in the U.S., they announced they intend to commit up to $6 billion for a new data center campus in Lancaster, Pennsylvania.
$6 billion in Pennsylvania.
Starting at 100 megawatts, but expandable to 300. And then internationally, they announced an incremental £1.5 billion in the UK.
Which brings their total UK investment to
a substantial £2.5 billion. They're moving globally, and they are moving fast.
And it's not just about building the infrastructure. They're also investing in the ecosystem itself.
Precisely. They want to make sure they have customers tomorrow, not just today. They acquired a company called OpenPipe, which is a platform for training AI agents.
So they're investing in their future customers' development pipeline.
Exactly. And they launched CoreWeave Ventures to directly back founders and companies in that AI ecosystem. It's a whole strategy. Build the tracks, finance the trains, and help fund the passengers.
So if we look at this whole Q3 report as a strategic blueprint, it's a company that is aggressively trading short-term GAAP profit for, they hope, massive long-term market dominance, all backed by that $55.6 billion backlog.
That's the bet. And the ultimate takeaway for you, the listener, is really the signal sent by those 4-year-plus commitments.
The long-term view.
Right. When half of a $55 billion backlog is scheduled for way out in the future, it fundamentally changes the market. It means the biggest AI players see sustained exponential compute demand for the next half-decade at least.
Which raises the big question.
The provocative question. Will this massive upfront capital spending and specialization lead to a permanent consolidation of AI infrastructure in the hands of a few companies like CoreWeave? Or will the hyperscalers manage to pivot and catch up before that 2.9 gigawatts fully comes online?
That is the race we will all be watching. Thank you for diving into the numbers behind the AI boom with us today.
My pleasure.
Keep following the infrastructure. It's the truest measure of where this entire industry is going.